to KYC, Know Your Counterparty, hosted by PM Insights. I'm Nick Fusco, your host, and here with Scott Chou from the ESO Fund. Really excited to talk to you today, Scott, but would love just for you to introduce yourself, what you do at ESO Fund.
All right, thanks, Nick. Glad to be here. So I'm Scott Chou. I've been a venture capitalist for 28 years. The first 15 were at a traditional venture capital firm, and during that time I discovered this opportunity that was the basis for the ESO Fund, the Employee Stock Option Fund, which I've been running for the last 13 years. And that's the fact that a lot of people simply can't afford to exercise their stock options. It's just that simple.
Right.
Everyone in this business, all the employees, they join these hot startup companies because they want to potentially make a lot of money if the company is successful. And as a result, they have a bunch of options. And if you multiply the number of shares by the strike, it's a big number. And then what no one prepares for is the taxes. When you throw in the taxes that get triggered when you exercise, then it becomes an astronomical number. And that's the business we're in. So if you come to me saying that you have a $500,000 exercise and you can only afford to do like $100,000 yourself, I'll pick up the other $400,000 on a non-recourse basis. So basically, I solve that problem for a lot of people every day of the year.
Very, very exciting. And I think that makes your firm look a little bit different than the folks that we typically deal with at PM Insights. So oftentimes it is about liquidity. It's about connecting buyers, connecting sellers, finding the appropriate counterparties to do it. But I think not only do you operate a little bit differently than some of the broker dealers or the platforms, which is great, you also can operate in a different end of the market. So I'm curious, what from your history, given you're a venture capitalist, brought you towards this end? Was it just a light bulb moment? You saw this as the most appropriate way to efficiently access companies that maybe you couldn't get in the venture capital seat?
Yeah, that's a large part of it. It basically is a lot of companies that you can't invest in directly. You could do this way, essentially the secondary market. That's why everyone's in the secondary market, except this is a particular angle. Our angle is, I consider it long tail. It's a lot more difficult. You see billions of dollars of secondary funds out there, and they typically provide liquidity and tender offers to the whole company or to founders, executives. And that's a pretty efficient way to invest. You find a company you like, you negotiate a deal with them, you do extensive diligence, and you place many millions at a time. Now, the way we do it is basically rounding up cats and dogs. We only put a few 100,000 per company, okay? So not because there's a limit or anything. I mean, a company has a lot of people coming forward. We'll do several, but the cost of the exercise is what it is. If a person has an $8,000 exercise, that it's not like I could turn it into a $1 million deal because I'd rather do deals $1 million at a time. 8,000 is so. It is what it is. And your average rank and file employees will only have a modest size exercise. In fact, the average across our whole portfolio is maybe 125,000. So that's pretty inefficient by traditional venture capital standards. Institutional VCs, don't like to do deals that small, but we have to do a ton of them. So we really operate our shop more like a fintech e-commerce type of a platform where we can handle hundreds and hundreds of people every single year. So a high volume of transactions, a large variety of companies. I mean, a typical VC fund might only do like 20 or 30 different companies in a portfolio, whereas we'll do several hundred.
That's
okay.
fantastic.
In order to do that means we have to be on top of a lot of things. And we also have to make decisions really fast because these people usually only have a few days before they expire.
Right. Yeah, I think you and I had spoken prior, and sometimes that window is 30 days, and sometimes it's 60 or 90. But oftentimes they don't even think to pick up the phone and call someone like yourselves for a week or two. There's so much in a state of flux. They're figuring out their new role.
Yeah, there's no doubt. I mean, there's at least 12 times in our history where we've transacted within 24 hours.
Oh wow!
And that's usually a company that we're familiar with. Okay, but there are many times where we've transacted end to end, within a week for a company we've never heard of. Generally speaking, I'd like to tell people that give us at least 30 days to go end to end for a company we've never heard of. And if it's a company we have processed recently, then we could do them very quickly.
Great. So I would love to just hear the quick elevator pitch for the employee, which I think is the most obvious, and then on the fund side, who are your investors and how does that operate? So starting with the employee, they've just decided to move from firm A to firm B, and they're sitting on a $500,000 worth of options.
Yeah,
So
those are the golden
what should
handcuffs.
I be asking?
Yeah.
Exactly. The golden handcuffs is a
Right.
great thing typically for the company, right? But
they're designed to be that way.
right.
And people, life happens, so people have to switch companies for all sorts of reasons. A very common reason is another company came along and it's a big promotion for you, and but you don't want to leave a ton of equity, on the table, because those options have to be exercised within 90 days. That's an IRS thing,
Right.
the way they're designed. And then, of course, a lot of people don't know about it, so after searching around the internet for a solution, they usually find us with X number of days left. But that window, and being forced to react during that window, even though the transaction is smallish by EC standards, that's our entire specialty. And people usually, they like their companies, and they often will invest some amount into them, and they usually have, but they usually can't do them all.
Right.
Okay, the exercise alone, because people often negotiate for something that's at least as big as their annual salary. So that means when you exercise, you have to write a check equal to your annual salary to get it done. And then on top of that, taxes, depending on how late stage the company is, could be several times your annual salary. So I don't see too many people wanting to do all of that. And then on top of that, we craft the transactions in a tax efficient manner. So we spend a lot of time, and this is one of our major differentiating facts, is looking at your unique situation, ISOs, NSOs, married, trusts, international, which state you're in, and crafting a tax-efficient transaction just for you, such that your deal is effectively cheaper. I mean, in addition to just providing the capital, solving your primary problem, but
Right.
making it a lot cheaper, because we're saving you a bunch of money in taxes that you wouldn't have been able to do on your own. That's a pretty big deal. And there's another aha moment, from the perspective of the client, and that's when they discover, like for example, I make them an offer, and the offer is usually centered around, okay, I provide all this cash, and we'll split it, like say 70-30. Okay, 70 for you, 30 for us. That's pretty common.
Right.
And sometimes they get all hung up about, okay, do I really want to share 30% with ESO? Okay, but then I point out, okay, don't forget that you didn't have to invest a penny to do this. Okay, you got your 70%. I took all the risk. All right, so you can take that equivalent amount of money and still invest it in something else, and the sum of that something else plus the 70 is usually bigger than if you just simply did the deal by yourself. Okay, and not to mention that you'd have a more diversified portfolio, because you'd have 70% of your own stock plus you have 100% of something else, which could be a lot safer. Or it could be, more speculative. It could be Bitcoin or something like that if you want to do something really aggressive and actually make more. But those are your choices. The point is you end up having more. All right. And once they realize that, then that makes our transactions a lot easier. A lot of people, it kind of makes them like free in a way. And,
I mean, that's a nice way to look at it, because I would say I would beg to think a lot of the folks that give you the yes and they sign on the dotted line were really not thinking they were going to stump up all the cash themselves in the first place. So maybe they only would have taken a quarter of the transaction anyways, right?
That's
so
true.
It really makes a lot of sense.
That's true. I mean, they do as much as they can, but oftentimes it's zero, because when they appreciate the leverage value, then they would rather have zero, because even the 25% that they would have put on their own, that also could be used in the diversification pool. Something more liquid, something that they could sell. Your average startup company, especially these days, is it's getting pretty long in the tooth. We're going
Right.
to, I mean, historically maybe 8 years to an exit, but now it's going to be 10 plus easily, because we've had 2 or 3 years of being stalled on top of that. So we're going to probably average 11 plus for the current vintage companies that haven't exited yet, and that's a long holding time for the person. Even if they came in 3 or 4 years into it, they still got 7 or 8 years to hold. And that's a lot of time to be illiquid, to have the capital tied up. So that's
Right.
perfect for leveraging our capital.
Right, and typically the names that we look at PM Insights, where we have daily information, just a lot of comparables, things of that nature, they're going to be your big growth stage names.
Mm-hmm.
The fact that you can diversify and go such a broad pool, I would imagine a lot of the folks you work with are a little bit earlier than that. So you're not doing your Series Gs. You're like Series
right.
A, Series B, Series C. You can do a lot more than is typical. So
That's true.
I would definitely say that
Obviously we'll do the late stage famous companies.
right, and those are
but,
easier to price out.
Right, those are easier, but we have made a name for ourselves, our willingness to go earlier.
Right.
Okay, and we're taking on quite a bit of risk and a lot of time value on the money by going in early. And it's also fair to say we didn't put a lot in earlier. And it's a good thing that the earlier stage companies, their exercise prices are smaller. And that makes it easy, so we at least get the first bite in. A lot of people, in fact, they haven't even heard of something called qualified small business stock. So
Right.
if you exercise early enough, you don't have to pay federal tax.
Right. The
On your
QSBS
profit. Yeah, that's
is
right. I mean,
one of the most incredible, most tax efficient things you could do as a small business. So
right.
you
Most
don't
people
you don't
think
want
of
to let
that
go of
with
that.
as angel investing, but I tell them that when an employee exercises, that's the same thing. When you exercise an option, you are an investor in that company.
And
So if
that's
you
when
do
the
it
clock
early
starts
enough,
for you,
you're
right?
also eligible. Yeah.
Right. And that's brilliant because oftentimes you start the clock on the QSBS. Your 409A is below the strike price for a lot of these younger companies, I would hope. And you're really getting some unique tax benefits there, depending on the classification of the company. So I think that's great.
Yeah.
But then you're right. The risk that comes into play in my mind is more about duration risk, because we don't know when the liquidity event is going to come on
Right.
some of these smaller companies. But would love to hear your thoughts on
Yeah. It's marketing to some extent. I'm not trying to say that I'm going to try to lose money on purpose. Okay, but getting those first few deals done early stage starts what we call the referral funnel. So if the
Right.
company takes off, then we'll have sort of an in that starts with information. Because it's easier to sort of study the company's history over time. Like you refer to the next batch of people, and the intermediate stage, and the intermediate stage they'll refer to us to a big batch of people at the late stages. Okay, so it makes it a lot easier than trying to do the companies cold all at once when they're super famous at the very end.
right. Yeah, but I'm curious on the idea of we're expecting a lot more M&A activity in the next 4
You
years.
you are or
We certainly are.
okay? Is that
Uh,
just wishful thinking, or you have a specific insights?
there's no crystal ball, but I think a lot of it's
Okay.
from the current administration, right? It's going to be easier to see transactions through, see transactions getting done. I personally, I'm not going to speak for the entire team that we have here, do not think that the IPO window is going to get any more clear. I don't think they're going to be
Right.
brand new IPOs left and right, as people are really hoping for, but I do think M&A is going to pick up. So I'm
Yeah,
curious
but those two
what your
those two
thoughts
markets
are.
are usually joined at the hip. I mean, usually when you buy a company, you have to use your own currency, and if your own stock isn't trading that well, usually you don't get too many green lines from management to go buy stuff. So they kind of come and go together. It's true that may be the only way to get out of a deal these in the next few years is M&A, but it doesn't mean that I think there's going to be a lot of M&A because it really does go hand in hand with the public markets.
Sure. No. So where my head is at on that is the reason why I don't think they're as interrelated. I actually expect a certain number of companies to go
Okay.
private. So
Okay.
just as Twitter was retaken private, whether it was good or bad for them, or
Okay.
good or bad for Elon, I
Okay.
actually don't think net we're going to see as much growth in the IPO market as we will in the M&A market, where you're going to have more private equity involvement. You're going to have more private companies taking over smaller companies as well and acting like some of the bigger players that are public. So
Okay.
I would really think that's a benefit to your clientele, who, that would be an endpoint for the valuation of one of those companies, or where the money can get returned, right? There's
Yeah,
your
liquidity. Liquidity is always a great thing. I mean, in a hot IPO market, it's going to be a lot better. The valuations are higher. The number of M&As that are right on its heels are higher, and the secondary transactions are higher because the people who don't want to hold a long time and want to pop out on a secondary, they're higher. These days, a lot of the liquidity comes from the fact that the secondary market itself, which I know that you've had a bunch of people on your show that are represent those entities. They're very active. I mean, a lot of the capital has been raised. A lot of people are pointing out to the fact that the stalled IPO market, this is a golden era for secondary funds to show up to provide liquidity since they can't get traditional liquidity.
Right.
So that allows a lot of our clients to get out too. The fact that there's so many secondary funds out there willing to buy some positions. So they're not going to get paid as much, but at least there's an opportunity to participate in company tenders and this and that. And that's where we're seeing a lot of action these days. So I would say that's mainly a benefit from like our LP's perspective. Okay, in other words, if you invest in a traditional venture fund, you can only get out with the M&A or the IPO. But through a fund that does microtransactions like ours, you can get out on a regular basis through tender offers and secondaries, which occur quite often.
Right. No, absolutely. We are. I mean, right around year end, we saw secondaries increase in terms of volume. Right at the start of the year end, start of the year, we saw the same. This past month has been a little bit slower, but I do expect the long-term trend to continue where secondaries are both at the fund stakes level and the individual company level just continuing to improve.
Yeah, there's no doubt. Secondaries right now are, by unit count, are our top category. Historically, IPOs dominate. The vast majority of our exits historically are IPO, but it's flipped.
Yeah,
completely.
Well, I'm personally happy to hear that, as that's the crux of our business. And then I guess I would just love to hear, what do you think is noteworthy as of late, as of the last 6 months or coming in the next 6 months, that you think might change the market at all? Or do you think the market's going to be up, down, sideways?
It's sideways. Mathematically, it's sideways for us. I mean, it was down, I would say, the 22 and 23 and 24, we started even seeing a little bit of a recovery, and we thought with the new administration there'd be a full-on rally, but then it just kind of fizzled. So I'm watching, and I say mainly I'm watching the up rounds, or the lack of up rounds. Okay, and you're doing the same thing. I'm also watching the 409A, and we're good. We can interpret them.
Right.
I know for an early stage company, how to sense whether it's making reasonable progress, because there's cohorts. There's hundreds of companies that are cohorts, have been through the same stage, have the same number of employees, similar amount of revenue. So I have a sense for where it should be, okay, and whether it's on track or off track.
Right.
Right.
And when you get the fair market value appraisal, do you take into account who's doing it from one firm to the next and how that could differ? So if you ever have one firm that's more conservative than another, and this might be going down an odd track.
Mainly, it's not the absolute value that concerns me, it's the relative change. All right, so I will get thrown off if you switch firms.
Right.
Okay, and there's a little blip there, and that blip is simply because two different guys did it, and they're literally working on the same numbers. Okay, so that will throw me off. But to the extent that you renew, most CFOs constantly go back to the same firm,
right,
until something really major occurs, and just your trend over time is what I care about, and that tells me more. All right.
Makes sense. All right. Well, I would love our audience to get in touch with you if anything that the ESO Fund does is compelling, whether irrespective of what side of the transaction they would be on. What's the best way to reach out, Scott?
Well, we have a website that's esofund.com. It's not too hard, and our phone numbers and emails are on there. And we have the phone always reception desk and all that stuff. We have an interactive voice response, and my name's in there. You can always call me directly. Of course, my email is scott@esofund.com. That's not too hard to remember. People are welcome to contact me that way as well as anybody on the team.
Right.
So we are consumer facing, and that's our primary lifeline, is having the general public contact us directly. You don't need a referral like you would at a regular venture firm. So we're happy to look at every situation, and especially with the taxes, and we're in tax season right now, so the phone's pretty busy, and you'd be surprised at how much better we can make your situation if you give us a chance to at least digest it and craft it. We can make it better than if you were simply do it by yourself.
Perfect. Yeah, I think it's always a slippery slope, so it's always worth the call. So there you have it from Scott, and this has been another KYC Know Your Counterparty with PM Insights. Thank you so much.
Thanks, Dave. Appreciate it.